Hello everyone. Today we are going to discuss chapter 6, and chapter 6 is about merchandise inventory. In that chapter we are going to discuss how are merchandise inventory costs determined under the perpetual inventory system. Actually, under the perpetual inventory system, we are calculating the ending merchandise inventory by multiplying the number of units on hand by the unit cost of each unit. And we are calculating the cost of goods sold by multiplying the number of units sold by the unit cost. At the end of the period, count the units in ending inventory and assign dollar to the accounts. This is the most important issue to be taken into consideration in order to prepare the financial statement. At the end of the period, we are determining the units sold during the period, and we assign dollars to the cost of goods sold in order to be able to prepare the income statement. We are using many accounting principles to classify and report items on the financial statement. The accounting principle associated with the merchandising inventory are consistency, which means whenever we are using one of the accounting principles or policies, we have to keep using that in all the coming period unless we have something that will change our decision of using such accounting policy. Disclosure, we have to make a disclosure about all the accounting policies, the way that we calculated the cost through, and we have to keep in mind that all the material information that must be disclosed about the inventory to be disclosed in the financial statements, and the accounting conservatism, which means we are always tending to consider the losses rather than the profits, because actually we are preparing for the transaction that understating expenses and overstating expenses and understating revenues. We have two main concepts or two main inventory systems. We have the perpetual inventory system and we have the periodic inventory system. Actually, the perpetual inventory system is to be calculated through a card or an inventory card like the one that we are seeing now, and actually this card is stating the date, the quantity purchased, the quantity sold, and the cost per unit, and the quantity on hand. If you can see here, in August 1, we didn't purchase anything, we didn't sold anything, and we didn't sell anything, but the cost is 350, and this is the 2 units that have been transferred from the previous month, and this is the beginning for August. Then a transaction happened that we purchased 4 units with the same cost, so actually the inventory that we have, the 2 units, will be added to the 4, so it is 6 units. And then we sold 4 units out of the inventory, so actually again the number of units will decrease to 2, and we purchased another 12, so actually we reached 414, and we sold 10, so actually the ending inventory is 4, and the quantity purchased during the period is 16, the quantity sold is 14, and the quantity on hand is 4 units. Of course, as you can notice, each unit originally cost 350, and the ending inventory equal units on hand by unit cost, okay, and the cost of goods sold will be calculated according to the unit sold multiplied by the unit cost, as we said before. When the costs are different for different groups of inventory, it is more difficult to decide which dollar to assign to the ending inventory. Yani when we have units that have been purchased with different costs, yani these 4 units have been purchased here for 360. The 2 beginning inventory units have been purchased for 350. Those have been purchased for 380. So whenever we reach for the total unit, as we did in the previous example, which unit are we going to multiply the unit with? So here comes back what we are talking about. We have to have a way to assign the costs to the units that are in the ending inventory and hand in the cost of goods sold. So actually 4 basic inventory costing methods are allowable. Okay, the specific identification, first in first out, which is FIFO, last in first out, which is Lifo, and the weighted average. And we are going to discuss each one of those. First is the specific identification method. The specific identification method is used when company knows exactly which item was sold and exactly what the item cost. Which means here, if we are aware, like in cars, for example, we have to have details about the cost of each model of the car and each brand of the car. So actually here, I will use the cost that is appropriate for each unit, because actually each unit is identifiable. This is why the method here called specific identification, which means you can identify each unit from the other one. Like in automobiles, unique artworks like antiques, jewels, okay, and real estate. Actually, in those, okay, for example, we can identify each unit. So based on that identification, we can find out the value or the cost for that unit. If you can see here, I made the same table, but actually here, because we have several cost per unit, actually we have to have a more detailed schedule. So actually here I made the same 3 headings: purchase, cost of goods sold, inventory on hand, where I divided each to 3 main columns: the quantity, the unit cost, and the total cost. Quantity, unit cost, and total cost. Quantity, unit cost, and total cost. On August 1st, we have 2 units. The cost was 350, so the total is 700. So all what we have now is 700. On August 5, we purchased 4 units for 360, equal 1,440. Okay, but actually here we have to write the details, which are 2 units from August 1 for 350, 4 units came from August 5th was 1,440. So actually the total inventory here is 2,140. And then we decided on August 15th to sell 4 units. Type. We are using specific identification. So actually this information is given that we sold 1 unit of the 2 units that we started with, and 3 units from the $360 cost per unit inventory. So actually here, when I sold 1 unit of the 2, the remaining is 1 unit. And we sold 3 units out of the second purchase, so actually the remaining is also 1 unit. 1 by 350 is 350, 1 by 360 is 360, and this is the new total that we have. We purchased another 12 units for 380, so actually I get the 2 units that we talked about, and then the 12,000 as usual. When I'm going to sell, I will say that I sold a unit from the first one and 9 units from the third one, which means that one is still here. Okay, so actually it has been transferred as it is, and the 3 remaining units, because I sold 9 out of 12, so actually the ending inventory is 1,500. Okay, because I have 1 unit of the 360 and 1 unit, okay, sorry, with 3 units of 380. What about the cost of goods sold? Actually, it is the addition of the total cost here. I'm going to add all of this in order to reach for the cost of goods sold. Okay, so actually this was the first method, which is the specific identification. Then we are moving to the second method, which is the first in, first out. And this is actually more valid in the food industry, for example, because actually you have an expiry date, so you have to sell what you have produced first, and then the next batches, and then the next batches, and so on. So the first in, first out assumes the first unit purchased are the first to be sold. The cost of goods sold is based on the oldest purchases, because you are selling the old inventory first, and the ending inventory is reflect the current replacement cost, because actually it will be consistent of what you purchased خلاص recently. Okay, and this is our table again showing the same example using Fifo. First in, first out. So we started by August 1, 2 units by 350, it is 700. Then we purchased 4 units, 360, so the total as we did before. Here comes as a change. Whenever we are going to sell 4 units, I will start selling the first number of units, and then to sell the next units from the next units type. In order to make it easier for you, I think it is better to you to think as we are going to store this unit on shelves. So actually, what it comes first to be stored on the first shelf. This is number 1 shelf. And whatever comes next to be stored on the second shelf. So whenever I'm going to sell, I have to go from up to down, which means I will start by selling the 2 units. Okay, so actually it is 2 units by 350, and then I need another 2 units because I'm only want to sell 4 units. So actually here I will only take 2 units of the 360. So actually here this unit have been sold, and this one we got 2 out of them, so the remaining will be 2 multiplied 360, which is 720. And then we purchase another 12 units, so the 2 units will be transferred down and the 12 units will be added. Whenever you are going to sell again 10 units, you will start by the 2 and you are getting 8 out of 12 and the remaining is 4. Again, the cost of goods sold here is 5,180 and the total cost of ending inventory 1,520. The next method is the last in first out method, and it is the opposite of the FIFO, which means inventory is sold is the cost of the newest item in the inventory. What comes last goes out first. So actually here the cost of goods sold will reflect the current replacement, and the ending inventory will contain the oldest costing unit. And here comes our example again. We started by the usual 2 units, we purchased another 4. And here comes again the change. Here he is saying last in, first out. We are going from the bottom to the top, which is the opposite of the FIFO. I will start by the 4 units first. 4 units multiplied 360, 1,440. And the remaining, we sold that, so the remaining is 2 units. And again, we purchased 12 units, so the 2 units will be transferred, and we will add the 12 units. Whenever we would like to sell the 10 units, I will start again from the bottom. So actually here this shelf include 12. I will got 10 out of them. I will got 10 out of that 12. So the 2 units here will be transferred as it is, and the 12 units will decrease by 10 to become 2 units only. And again, this is the cost of goods sold, and this is the inventory, ending inventory or inventory on hand. The last method is the weighted average method, and actually the weighted average method computes a new weighted average cost per unit after each purchase. I don't want to sell from the new products or the old products, but actually I would like to make a weighted average because my units are homogeneous, like the pencils, which means all of the units are the same. So actually it doesn't matter if I'm going to get it or sell from the last one or the first one. And the ending inventory and cost of goods sold are based on the same weighted average cost per unit. The average cost is computed as cost of goods available for sale over the number of units available for sale, and this gives me the weighted average cost per unit. As you can see here, we started again by our 2 units by 350, which is 700, and then we got 4 units. So actually we have a total now 2 units plus 4 units are 6 units, and we are multiplying that by 356.67 per unit, which is the total of $2,140. How did we get the $365.67? Actually, this has come through. We have 2 units. Okay, the total cost is 700. This one. And we purchase another 4 units. Okay, the total cost is 1,440. So actually here I have 6 units, and I have here 0, 4, 1, 2. 2,144, 6. I will divide, as we said, the 2,140 over the 6 units. So actually I will find that I have 3, 5, 6.67 as we are showing you now, which is here. So this is the average. This is the average. So whenever we are going to sell later, I'm going to use that cost and the remaining, which is 2 units, because I sold only 4 out of 6, which is 2. It will be multiplied by 365. Okay, type. We purchase another 12 units. So actually now we have 2 units, right, and 12 units. And again, I will repeat it once more, 713. And I have 4,560. Okay, I have a total of 5,200, 5,273 point. Okay, those are 14 units. I will divide them again to get a new average. So at the end, when I sold another 10 units, I will multiply it by the new average. So actually, again, the cost of goods sold will be the addition of that, and the ending inventory will be, as you can see here, 1,507, which is what is remaining there. Okay, so actually now we talked about the 4 systems, the 4 approaches to be used in order to find out the cost of goods sold under the perpetual inventory, So now I would like to explain how that will affect the income statement, because actually every time we are using one of these methods, actually we have a cost of goods sold and ending inventory that is different than the other. This is why the income statement will be affected and the balance sheet will be affected. Income statement will be affected through the cost of goods sold, because the higher the cost of goods sold, which will be resulted under LIFO, okay, the less the profit will be. And the net income is lower under LIFO, as we just said, because actually again the cost of goods sold is very higher. And on the opposite, FIFO will give me the lowest cost of goods sold and the highest profit. For the balance sheet, when costs are increasing, FIFO will be the highest, because actually the inventory number in the balance sheet is the ending inventory, and LIFO will result in the lowest, as you can see here. So this is a summary. When we have sales revenue the same for the 4 method, and actually those are the numbers that we resulted from each table that we explained before. If you can see here, the highest cost of goods sold is under the LIFO, and the lowest is under the FIFO, and the weighted average is an average between both, and the profit by default will be the lowest under LIFO, and it will be the highest under the FIFO. And this is what we just explained in the previous slide. This is again a comparative results for the ending inventory that we actually calculated also. If you are looking here, actually the FIFO is giving me the highest cost for the inventory, and the Lifo will giving me the lowest cost of inventory. And these two numbers are the numbers that will be recorded under inventory in the balance sheet. Okay. If you are looking here to the effect of the on the financial statement during the period of rising and declining inventory costs, you will find out that in a specific identification it will always varies according to the change happen in the market. But in FIFO, again, cost of goods sold will be the lowest, income highest, and ending inventory is highest. Lifo will have the highest cost of goods sold, lowest income statement, net income, and lowest ending inventory. Weighted average, middle, and middle, because this is the average. This in case that we have a period of rising inventory. On the other hand, period of declining inventory cost, as you can see here, it will vary in the specific identification. Actually, in FIFO, the cost of goods sold will be highest, net income will be lowest, and ending inventory will be lowest. Lifo will be lowest cost of goods sold, highest net income, and ending merchandise inventory, and the weighted also will be middle. How to measure the effect of merchandise errors on the financial statement? Right. If an error happens, what will be the effect on the financial statement? Actually, three main accounts will be affected: the cost of goods sold, the gross profit, and the net income. Those are the main accounts that will be affected by any error related to the miscosting of the inventory, whether it is cost of goods sold or the ending inventory. This is an example for overstating or overstatement of 5,000 for the ending merchandise inventory. The sales revenue is correct. The cost of goods sold, the beginning merchandise inventory, is correct. The net cost of purchases is correct. The cost of goods available for sale is correct, but actually the error is here at the ending. We overstated by 5,000. So actually, when that is overstated by 5,000, which means you are going to subtract more 5,000. So the cost of goods sold will be understated. And because the cost of goods sold is understated, the cost of goods sold is to be subtracted out of sales. So you are going to deduct less 5,000. So the gross profit will be overstated by 5,000. The operating expenses is correct, but the net income will end it by overstated at 5,000. So actually, one error in the ending inventory can lead to other errors in gross profit and in net income. Type the opposite بقى, a case of an understatement of 1,200. This one is correct as usual, and here the error is that the ending inventory understated by 1,200, which means we must have deducted 1,200, but we did not. So actually the cost of goods sold will be overstated by 1,200, and the gross profit will be understated by 1,200. The operating expenses is correct, and the net income is understated, because actually here the gross profit is understated. So whenever we are going to deduct the operating expenses, the net income will be understated. As you can see here, this error can affect more than one period, which means if the ending inventory here is having problem, which is overstated by 5,000, so the beginning of the next period will be overstated by 15,000, and the ending inventory here, okay, the 10,000 will be transferred to the third period as a correct amount, because actually after 2 periods there is an automatic adjustment to happen in the inventory due to the accumulation of error. And this is apparent, as you can see, from the 50,000, which is the gross profit that's supposed to be in every period, but actually it appeared in period number 3. The effect of the inventory error: when we have in period 1 an ending merchandise inventory that is overstated, that will result in understatement of cost of goods sold and overstating of the gross profit. And in the next period, it will be reversed, which means the cost of goods sold will be overstated and the gross profit will be understated. If we started by ending inventory that is understated, the cost of goods sold will be over, the gross profit will be under, and then a reverse will happen again. This is what we just explained in the previous slide, that a reverse to happen automatically in order to eliminate the effect of the error. So actually we will have here a gross profit that is overstated by the same amount. The other issue that we would like to discuss is how to calculate the cost under the periodic inventory system. The previous part that we talked about, we used to talk about the perpetual inventory system. And the perpetual inventory system is up-to-date system. It tracks every unit, taking care of the cost of each unit. So actually you are very aware that a change happens whenever a unit comes to the company as purchases or to come out of the company as sales. So actually this is the system to be used by the big companies that have softwares and have staff to understand that. But actually here under the periodic inventory system, we are talking about the smaller size company which cannot afford a computerized system or cannot track each unit coming in or out of the company, like the supermarkets, small supermarkets. Okay, because actually they are having a lot of items and they are not tracking each item specifically or separately. The main characteristics of the periodic inventory system is that inventory is not tracked on the accounting system continuously, on the opposite of what we just said about the perpetual. The beginning inventory balance is carried until the end of the period, which means we don't know the ending inventory until we reach for the end of the period. Purchases are accumulated during the period, and the ending inventory balance replaces the beginning inventory balance through an equation we just saw in the previous slide, which is the beginning inventory plus purchases equal cost of goods available for sale minus ending inventory. This gives me the cost of goods sold. Okay, here this is a perpetual inventory record change in cost per unit. This is the same sheet that I show you before we go for the 4 methods under the perpetual inventory system. But actually here, when I will go back for the first one, we don't have a specific identification because actually it is the same specific identification. We are using the identification among the units, so we don't need to repeat it again. It is the same as the one that we explained under the perpetual inventory system. But actually here, first in, first out, we are saying that we have a beginning merchandise of 2 units by 350. Net cost of purchases, we purchased 4 units by 360 and 12 units by 380, so the total is 6,000. This is why we said we are not tracking each unit here. We are talking about totals. So actually the total here is cost of goods available for sale 6,700 minus ending merchandise inventory 4 by 380, which is 1,520, and we have cost of goods sold, which is 5,180. So actually here the ending inventory is 1,520 and the cost of goods sold is 5,180. Ending inventory will be calculating using the newest item in inventory, and the cost of goods sold will include the oldest cost. You can do it from here because actually Fifo, we are selling the first, so actually the remaining will be out of the 12 units. This is why I said that these 4 units will be multiplied by the 380. Okay, on last in, first out, the same 2 by 350, which is 700, 4 units 360, 12 units 380. This is the total. This it does not differ among the different approaches under the periodic. Whenever we are going to calculate the ending inventory, we are last in, first out, last in, first out. I'm selling from here. Okay, so actually I have to multiply, I sold 10, so actually the remaining from that one is 2 units by 380, and I have the last 10 first out, so actually we sold the 12,000, so the remaining will be 2 units of 360 and 2 units of the 350, which is 1,420. The ending inventory will be calculated using the oldest. I can, by the way, calculate the cost of goods sold first. يعني I'm talking about Lifo, so actually I will sell the 12 units first. 380. If you are getting confused by calculating the ending inventory first, and then I will sell the 2 units of the 360. If you calculated that, it will be 5,280. In that case, I have 6,700 available and I have 5,200 sold, so the ending will be 1,420. يعني I can do it either in that way by calculating the ending merchandise or by cost of goods sold. The last one, which is the weighted average, we are calculating the weighted average right away. I'm getting the cost of goods available for sale divided by the 18 units. Okay, from where did we get the 18 units? The 2 units from the beginning and the 16 units that we purchased. So actually the average cost will be 372.22. So the beginning cost will be as it is, the net purchases will be as it is, but here in calculating the ending inventory, the 4 units will be multiplied by 372.22 and the cost of goods sold will be the difference. Or as we said before, you can get the units that I have sold, which is 14 units, multiplied right away by 372.22, and it will give me the same result. By that, we ended chapter 6, which is how to calculate the cost under the perpetual and the periodic inventory. Thank you. See you in the next chapter, inshallah.